Good morning, it's Tess, and this is Stay Curious with Tess. Today I want to talk about liabilities. I've been talking a lot about the basic terms of accounting, and for those that don't know, I am a 35-year statutory accountant, and what that means is I prepared the statutory statements filed with the regulatory boards for insurance companies. So insurance is my life. It's something that's been my passion my entire life, and now I'm on the other side of the desk, so to speak, sharing my experiences and sharing the things that I've learned later in my career that I really truly wish I had known sooner. So what I'm going to start with today is what is a liability? And this is kind of an important tool because everything interlinks together. So understanding all the different pieces and how they come together to make your picture is really important. So what is a liability? And the curiosity today is every debt or liability, an item that you owe to somebody, is that a bad thing? And really, I love this question because the answer is no. And this is where definitions matter and why I started doing this talk. I'm going to get into more of like the financing terms of like whole life policies and annuities and things like that as I get into this. But I thought start with the basics, start with what the terms are, because you can't make quality decisions until you understand really the underneath pieces, like I've talked about opportunity costs and net worth and things like that. So I think you have to have the picture conceptually to make the best decisions. So kind of a definition of liabilities is a liability is an obligation or a debt that you owe to another party. In simple terms, money or a responsibility that you are required to pay in the future. Some examples of this are, and you're going to remember me talking about this when I talked about assets, because something can be both an asset and a liability. A mortgage, why can it be both an asset and a liability? Because you have that home, but you may owe a piece of it to, say, a bank or to a private lender. A car, you may own a car, but you may owe somebody else part of the money because they fronted it for you. Credit card balances, you may have new furniture, but you owe somebody the money for the furniture you purchased. Business loans, the same thing, student loans. So the first question when you're looking at things in your life are, is this debt a good debt or is it a bad debt? And I think a better question really is, what is the purpose of the debt? And does the cash flow support it? Because not all debt is used in the same way. And a lot of us are seeing things like I've talked recently, because we work a lot with clients on debt elimination, and that's through the infinite banking concept. And I put a link here. You can book a call with me, and I'd be happy to go over that with you. But is it good debt to have a credit card at 30% interest? I was thinking about it recently, and I can remember younger in my life that the idea of a 30% interest rate was considered predatory. And I'm like, I want to do some research and look back on that, because what happened, and we probably all know the answer to that, but what happened, how did it go from not predatory to now it's normal practice? So I wanted to kind of share these things because I think education will give you power to make better decisions, if you so desire to make better decisions. And I think most of them want to. So I'm going to give you some examples and kind of talk about why they're liabilities and how to look at them. And the first thing is a mortgage, and that is a long-term personal liability. It provides you with a home, and it gives you the opportunity to buy a home without having the full purchase price up front. But it does come with a cash flow impact. Cash flow is the money that goes out. And remember, we've talked about that before. Income is money coming in. Cash flow is money going. Cash flow is looking at the income coming in and what you have to pay out of that income going out. So at the end of the month, the idea is you want to have a positive cash flow. You want more money coming in than what's going out. So the thing about a mortgage and the reason insurance companies, the reason banks are doing a lot of inquiries on underwriting is because they want to make sure that that income coming in every month is going to be able to support what you have to pay in the mortgage every month. And there are some alternatives, so please feel free to reach out to me. We have partners in this business that will help with like HELOCs or first position HELOCs, which use simple interest versus amortized interest. If you don't know about that, listen to some of my future talks because I'll explain the difference, and it's a big difference. I can remember questioning that when I was younger, but I didn't know what the alternative was then. It took until I got later in my life and connected with the right people to understand that there are other tools available, but it's not always in the best interest of the person that you're working with to tell you what those alternatives are if it means less money for them. I know that we don't want to think that that is the way it is, but unfortunately we have to be our own best advocate. I think that comes whether it's financial, whether it's medical, whether even in employment, we have to be our own best advocate. So now back to the talk at hand, a mortgage can be an asset, but it also can be a liability. So what you're going to want to make sure is that you consider the cash flow impact, because it does require monthly payments. And that also includes additional expenses on top of the mortgage in things such as interest, taxes, insurance, and maintenance. So the mortgage, property, taxes, insurance are liabilities, but both can exist at the same time. You've got your home and you've got the expenses associated with it. So number one, a mortgage asset is the home. The liability piece of that house is the mortgage. The purpose is to own a home over time. And the cash flow is the mortgage payments, taxes, insurance, maintenance, repairs, and utilities. Now, the same kind of thing can come up as a rental, but the whole purpose is that it's not a personal home. It's something that you're kind of using as a business investment. You're purchasing a home, but the purpose of it is not for personal, it's for business, that you're trying to take care of a home. And then you're going to loan it out or rent it to somebody with the idea that there's going to be more money at the end of it than what your cash flow was. And that is back to that cash flow. What income comes in from that piece of property and what expenses go out, and trying to make sure that you keep it in a positive place. Car loan, another personal use liability. It allows you to purchase a vehicle over time. For the most part, cars do go down in value, so you're going to want to take a look at that. But there are some cars out there that do go up in value, so that's worth investigating and learning about. But a car loan will allow you to purchase a car over time. So you'll get to drive it, but you'll still owe somebody a piece of that car. So it will require a liability, which is a note, whether it's a private lender lent you the money for the car or whether it was a bank. There's going to require monthly payments for that cash flow. And the vehicle could possibly lose value over time. And it is an asset, but there are offsetting liabilities to it. One thing you might want to think about, just kind of tossing it out there, is insurance is a good thing to have on your automobile, because if you have an accident, you could end up with no car and still a liability that you got to pay that mortgage unless you had it insured. And one little other caveat to mention, replacement value. So a loan, if you're going to think about the whole picture of a car loan, the vehicle is the asset. The loan, whether it's private lending or a bank, is the liability. The purpose is to have transportation over time, or if you're investing, if you purchase the cars that do increase in value, maybe an investment. And then keeping in mind, there's an asset, but it has an offsetting liability. So the cash flow is, you're going to have a loan payment, insurance, fuel, maintenance, and repairs. You may not have any income coming in from that, but you do have the asset. Now I want to go into the next type of thing we can talk about, and this is a business loan. And it's a business liability. And its purpose is to provide capital to build or to expand a business. Because, I mean, we're not going out there to get a business loan so that we can go further into debt. That's generally not why somebody would open a business. The cash flow impact means that you may get cash up front to purchase 5,000 journals. And the idea is that you want to sell those journals at a higher price than what you purchased them for, because you know that you borrowed money to purchase that inventory, so you're going to have a cash flow impact. You're going to have a liability, which is whoever you borrowed that money from. It's going to require repayment, and the goal is often that the business creates enough value or income to support that obligation. So if you look at the business loan and kind of identify it, the asset is whatever you purchased, whether it was 5,000 journals or whether it was a piece of equipment or whether it was a computer system. The liability is going to be the loan, whether you took out private lending or whether you went to a bank, but a credit card, whoever you owe for that asset. The purpose is to grow a business, and the cash flow is those payments that are going out. And the idea is, for cash flow, you want the income coming in from that business venture to be higher than what you're paying out to create that business opportunity. So the next one is credit card debt, and that one is a big one. We talk about that every single day. Credit card debt is, it's huge. It's huge in this country, and I really hope that through my life, I'm able to talk to more people about this infinite banking process that I've been involved in, because it is a consumer liability. And like I mentioned earlier in my talk, and I got to research this more, I can remember a lot of big talk about predatory lending. And I want to say at that time, 30% was predatory lending, but we know that it's common for credit cards to have a 30% interest rate now. And I wonder, how does anybody ever get out of it? How do they pull the pieces together? And it kind of breaks my heart, especially knowing what I do know now about the infinite banking concept. But credit card debt is a consumer liability. It provides access to credit, which means you can go out and purchase new furniture, have your home remodeled if you have a big enough credit line. You can go to school. I can remember when I was in college, I didn't qualify for like school loans, which is probably beneficial to me, at least where I'm sitting now. But you would have to pay for your next semester before you signed up, at least in the college that I went to. So if you didn't have the money, and I can remember Christmas was always hard, because if it was coming at Christmas time, there wasn't enough income to be able to pay a big, huge school bill. So credit card would be the way that I did some of my schooling, is because I couldn't register for a class. And when I got towards the end of my degree, I had such a limited, narrow window of classes that I would have to take, that in order to get into the class, I would have to, if I didn't have the money, I'd have to charge it, because otherwise, if that spot filled up, I wouldn't be able to get in the class. And that is that credit card debt thing. And the sad part is, nowadays, like I said, 30% is unreal, but there are tools available, and that's a lot of what we do is debt elimination. So please, I put a link in my chat, reach out, and my partner, Linda Snoltz, and I'd be happy to help you. But credit card debt is consumer debt. It provides you access to credit, but remember, there is a liability to it. You owe somebody for that money you borrowed. So it does have a cash flow impact. Are you getting enough of a value from it to offset that expense portion of it? Now, education is a value, and you'll have to kind of think about what that value provides, and if you can turn that around. But credit card gives you access to revolving credit. And so if we look at it in whole, we know that there is a liability, which is who you owe the principal back to, but you're also going to have an interest charge. So looking at the credit card idea in a whole, the asset depends upon what you purchased. There are certain things people do purchase with credit cards that really don't have an asset value, and that's kind of things like food or water or paper products. These are things that never make it as an asset on a balance sheet, but the reason is they're kind of disposable. They're in and out just as fast. You know, you buy food, you eat it, because within a week, if you haven't eaten it, you're throwing it away. So it never really gets to a point where you consider it an asset, because it doesn't have a long-term value. So a credit card may have an asset if you purchased a car or a piece of equipment or something that has a long-term value. The liability is whatever you owe for that principal that you borrowed against, and the interest associated with it. Its whole purpose is a revolving credit. And the cash flow is monthly payments and possible interest charges if you don't pay off that full balance every month. So those are kind of things that, you know, even myself, I've been in this industry for a long time. And these are things that I probably acquired over time, because I actually didn't go to school for accounting. I always laugh and joke that the insurance industry chased me down, and it didn't go away until I finally joined on to them. I had a headhunter when I was 18 years old who said, we need to get you in the insurance industry and it'll keep you in a career for the rest of your life. And I kept thinking, I don't know if I want to be in the same career for the rest of my life. So I made her chase me for 2 years. And then finally, after 2 years, I accepted a job, but it wasn't even the first job I was offered in the insurance industry. It was like the second or third, because I kept fighting it when she said, for 20 years, when she said, this will be what you do for the rest of your life. I'm like, yeah, I don't know if I like that idea. I kind of like a little variety. I like there to be growth. I like there to be knowledge. So the idea scared me, because I didn't understand the insurance industry. It was a great place for me. And if I could find her, I would thank her. I've tried to find her. But I just want to say that I understand a lot about the insurance industry, because it is my baby. It is my life. It is my career. And it has been for more than 35 years. So if you want to understand more about what I'm doing now with infinite banking to help people eliminate credit card debt, please reach out to me, because my partner and I would be happy to help you. So now back on to the subject at hand, which is liabilities and how we compare the asset piece of it, that there may be a corresponding liability. And you have to understand that so that you can keep your cash flow, or the money incoming to the money outgoing, in line every month. So the important lesson here is, just like assets, liabilities have a purpose. But the question isn't only, do I have debt? The question is better asking, why was the debt created? And does my cash flow support that obligation? So when we're connecting assets and liabilities, this is where people often have an aha moment. A home can be an asset because it has value, and it can have a liability attached to it through a mortgage or the expenses associated, interest and repairs, maintenance, insurance, those things. A business, it can be an asset because it creates a value, but it also can have a liability for the expenses that you use to operate and expand that business. So the existence of a liability does not automatically tell the whole story. We need context. So the great thought to ponder is, a liability is not just something you owe. It is a commitment to your future cash flow, and that liability needs to support your cash flow. So before asking, is this debt good or bad? Ask, what job is this debt doing? And can my cash flow support it? And then remember, we define and we understand so that we can decide with all the information gathered. And until next time, stay curious, keep learning, and take ownership of your financial education. Thank you for being here, and I look forward to talking to you tomorrow.